Welcome everyone. Thank you for being here today for our webinar. My name is Laura Baldin. I'm head of marketing and sales for AG Invest. With me, Paul Marriage, founder of Telworth Investment and portfolio manager for HI European Market Neutral, and Fred Batois, co-portfolio manager for the fund. So the purpose of the today webinar is just to review a little bit of, say, this first half of the year performance for the fund, and to point out to what we have done well, what we have done less well, but in particular also to give you a market outlook and to go also on some names we like on the market. So without losing any more time, we just start with you, Paul, to comment on the performance. Thank you.
Thank you very much. Thank you for listening today. So, yeah, really solid stuff. You'll recall that we took this fund on the end of last year for HI Invest, and Fred Batois joined us at the beginning of this year, to work hard on the day-to-day portfolio management. So we're really pleased to be in a really great position year to date now, and putting in pretty consistent positive performance. So that's a good place to be. How have we got there? I mean, this has been an incredibly difficult market to run money. I've been running long short money for 15 or nearly 20 years, and I've never experienced this kind of challenge. But our positioning has been good for us here. Remember, we're all about balance. We're all about having a balance between the different factors in a portfolio and keeping neutral. And that's the way we've always made money at Telworth. So at the beginning, we had a quality and defensive bias, and that probably helped us actually in the toughest part of the market. And we took the growth down and we're a little bit short. And the positioning there, moving really quickly at the beginning of COVID. And credit to Fred for really spotting the early impact of COVID. In Europe, perhaps if we'd been running this purely from London without Fred's European perspective, I think we probably would have seen it a bit later, as you can see from the general UK experience of COVID. So that was really good, and then clearly having that quite defensive positioning wouldn't have really helped us much as the markets began to recover. So it was actually really important for us then to have a much more balanced portfolio, adding little bits of value, giving us a chance to recover, but never losing sight of the fact this is a pretty fragile market, and good quality long-term stocks that can grow earnings are going to be the right place to be. So, we've got balanced exposure, we've got a lot of factor rotation in global markets, and we've managed to negotiate that reasonably well so far. And I think factor rotation will remain a theme all year, but I think perhaps not quite as violent as it has been in Q2. So in terms of how we've done it as the years progressed,
do you want to comment also on how you manage the net and the gross?
Yeah, absolutely. Yeah. So just looking at the net and the gross now, I alluded to the fact earlier that we did allow the gross to go right down a little bit short there. That was a great time to be a little bit short, great protection. Took it back longer into the recovery. So I think managing the net closely, tightly is something that we've always done pretty well at Telworth. And keeping the gross, our gross is pretty conservative here. We've never pushed the boat out to get these returns, and I think that's really important. I think you'd struggle to find a fund with this performance this year elsewhere in the market that had done it in such a conservative way. The gross barely going above 120. So also this has been about great shorts. Your longs are going to be really hard work in a market like this. So if you're going to make a positive return, it's all about great shorts. So just being that consistent, look at that performance in March, really balancing out that horrible month, and managing to sneak a small positive with a great short book contribution. And again, the shorts coming through pretty well for us as the month has gone on, and that's why you invest in a long short fund, isn't it? So, I think it's important to see how the contribution has come from both sides of the book, and how we've delivered it in a very balanced and actually pretty conservative fashion. So I think these all highlight strong features of the strategy, and if you want to test a strategy, then H1 2020 was the time to test it, wasn't it? I mean, we've not seen this before. So, I think it's a great credit to Fred and the team that, we've managed to get through this period with these pretty tight parameters and still deliver some pretty solid returns for investors. So, I think it's been a good balanced performance. Fred, do you want to talk a little bit about how we've got there in terms of the winners?
Sure, yeah. Just one point going back to the gross and the net. It's important to keep in mind that the net has been going down and the gross has been reduced in two different phases. There's one phase which was basically the March period, which was obviously the time to degross and also to be very neutral to negative net. And the other period has been as well the end of May and beginning of June. It has been the period in the largest, one of the largest, I think it was the biggest in 20 to 25 years, depending on which bank you follow, whether it's Citigroup, momentum long short, and a growth versus value long short index, or if you use Goldman Sachs or Morgan Stanley. So in this period, end of May, beginning of June, we reacted pretty quickly as well to degrow and to reduce the net. Why? Because we were at some extreme situation in terms of factor investing, and as Paul mentioned, the quarter, the Q2 period was very tough, probably as tough, if not tougher, than the first period, which was a market dislocation, because the volatility had come down, but within the market, you had between defensive and I will call a bit more cyclical, you had extreme and violent moves, and we tested the strategy in those two different periods of time by degrossing and rotating in a way which enabled us to go through this period without big damage. Going to the next slide, as Paul mentioned, thanks for this transition, Laura. So those are examples of names that have been had very strong contribution to the performance during this period of time. Some of those names are no longer here, as we will explain later on. We are trying to keep it to keep the fund in a neutral way, and names like Adyen, which has been a fantastic winner for us, or SML, are no longer in our long book. But we still have Ocado, we still have Cellnex, we've got some Worldline, we've got Reckitt Benckiser, which is one of our best defensive and staple company, reporting amazingly strong numbers. The comparables going forward are very easy to beat as well. They have last year reset the margin. Obviously, they benefited from selling some hygienic product and the detail products, kind of products in the homeware and hygiene. Look at Danone, is a defensive name which is down 7% today, and we are short this one. So again, we try to keep it on a bottom-up approach. We try to keep it with winners and losers. Who is going to get market share? Who is showing some acceleration of earnings, acceleration of sales, and who is doing relatively better than the other one? The names that are on this list have been big contributors to the performance. The reason why some of them are not there, two of them, which is Adyen and ASML, is because of the valuation. We don't look at valuation on its own, because obviously, as you might be aware, you look at the Nasdaq. Nasdaq is up like 13% year to date. It's not. We don't just chase the growth and short the value. It would have been a great trade, but we don't do that. Otherwise, we would have been wiped out during this June period, completely wiped out, because you had the complete opposite in a matter of days. You had moves which were, as I said, so aggressive that the drawdown would have been very bad for us. So the good news in the way we manage the risk is we try to keep it balanced, as Paul has said. So ASML, Adyen, two examples of stocks that are big winning stocks, but the valuation on a relative to their growth is at sky high level. So we can't chase those ones, and we've done well on them. But now, despite the growth relative being better than the rest of the market and better than some other tech companies, you are at extreme levels. So I think this is just a snapshot of some of the winners. We can go to the next slide if you want. Yeah, so interesting. I like this slide because it shows some of the shorts that have been good ones for us, and I like it even more because you have names like Rolls-Royce. So Rolls-Royce, for instance, is seen as a very value company, value. So again, some people might say it's part of some baskets, like value baskets. If you use Morgan Stanley value, it could be part of that. But to us, it's not value. The reason why it's not value is because when you look at the number of shares, is wrong. They basically need to raise capital, and they might need to raise as much capital as the entire market cap. So again, value growth debate. It looks the same. It's similar to what I just said. Sometimes you think something is value and it's not value, and sometimes you think something is growth and expensive, but it's not, because you can't just look at PE. You have to have the earnings right, but you have as well to have the number of shares right, if you see what I mean. So the number of shares is and if you buy a very bad balance sheet just because it's cheap, this might just not be at all a cheap stock. So we look at the balance sheet metrics as much as we look at the P&L and the cash flow metrics. So those are some example of shorts. Fraport is another one. I'm hearing every day that this is a very deep value, or it's a cheap stock. I disagree completely, and we've disagreed on that. The reason is they are an airport operator, but before the crisis, they were already at a very high net debt to EBITDA. They were already free cash flow negative. So just the earnings and the PE cannot make a stock being attractive and cheap. So again, this is just down a couple of examples. We've tried on the short book to be quite not as, I would say, stubborn when something don't work and we see that we're wrong on it. We just try to rotate into a different reassess our thesis, and we try to rotate some of the names that have done really very well for us on the short book. But I must say that on those typical examples, we are still short those 4 names, and we've been for quite a long time. The last bit at the bottom of the slide is showing that we use tactical shorts. That's correct. I think the short book, it's stocks go down faster than they go up usually. As we say, you take the elevator on the way down and you take the steps on the way up. So some of those names have been good performers, but we need to complement that with some tactical shorts, and sometimes we use as well some sector swaps and sector shorts when we believe that some sectors are just wrongly valued or will be, in our view, where the earnings downgrades are going to be much bigger than what the street was expecting. So those are the second category, which I would call more tactical shorts. We can go to the next one if you want.
Yeah, or more on the macro side.
Yeah,
maybe.
I think thanks, Fred, for going through it. It's absolutely key if you're going to deliver in a portfolio like this. You get your stock picking right, and clearly stock picking has been strong so far this year. It's been an absolutely bonkers year so far. We've talked about that so much. The V shape of the recovery. When we came into this, it was a very, very difficult place. And for the last time we had a webinar, people were coming out of lockdown. We were a difficult scenario for a lot of countries and a lot of people. And it was inevitable that was just going to create an incredible amount of stimulus. So the world is awash with money. As you say here, 20% of global GDP. These levels of stimulus, we thought we'd kind of seen stimulus and that was in the rearview mirror, but no, we've got a lot more. I guess the value of money is something we're going to be questioning more in the future. But fundamentally, massive stimulus is a positive for stock markets. So it's generally an equity positive, and we need to work out kind of how to play that, conscious that all these banks have clearly got some pretty extended balance sheets and balance sheet intervention in the central banks now. So I think generally the ECB has played this pretty well, probably pretty consistently well actually so far, as have most European countries, I think. So yeah, we've got a lot of stimulus, and we've got to work out how to make sure we're in the winners from stimulus. Fred, do you want to maybe talk about impact on the market?
Yeah, sure. Yeah. So interestingly, as you said, the ECB is basically throwing so much money. So does the Fed. So does everybody on the fiscal side and on the monetary side. This is the only reason why we've seen such a compression of volatility, which you can see barely on the top left. So the volatility has basically gone from an extreme 80, using the VIX index, 80 plus points level, and been compressed to sub 30, which is still high versus historical standard, which is why, again, we try to keep things A, flexible, and B, balanced, and C, try to really make sure that the risk we're taking is well under control, because the volatility is still high. It doesn't look like it because the market had a V shape. And what the central banks on the entire world level have done is unprecedented, and it has helped the market massively, but it's still pretty high. The right side of the chart on the top one is showing the impact of that. So obviously the PMI have been to, again, unprecedented drop level. We are expecting today, US GDP down probably in a level that has never been seen before. What is interesting is the new orders to track, not only the PMI, but the new orders. Again, the new orders and the PMI have done a kind of V-shaped rebound. And this is due to this massive compression of spreads that the central banks have done by throwing massive amount of liquidity, completely unprecedented. And by doing so, the high yield has compressed, the normal investment grade has compressed, the mortgage-backed securities, there's been, again, we've just went back, and we did what happened in the great financial crisis and took a lot of time. We did it faster with much more money in, which is one of the reasons why, despite having shocking numbers, you see that the earnings season is really bad. The Q2 numbers are awful. I mean, I've rarely seen like some company like Danone telling us that their water business, which is 20% of the business, is down 25%. So their organic growth is down 6%. Some of those cyclical names are even down 90% plus. We've got a short in our book today, which is Inchcape, a UK company, which is they are basically a retailer of autos, like auto concessions. And those guys are telling you that the numbers on the retail side was down 98%. So it's unprecedented, but things are reopening. And the only reason why you've seen such a repair at the stock level, despite the economies being massively shut down and reopening slowly, but not massively, is because of this liquidity injection. On the bottom left, you can see the impact. So the impact on this chart is to show how much private clients have basically put into equities. So you see that this bar down and up has been really brutal. And on the right side, you've seen a very interesting chart, which is the outperformance of tech versus banks. So we've reached a level which we had not seen since 1998 or 2008. Again, it's a bit normal. You think that which companies are benefiting from working from home and there's been a massive move of digitalization, which is why on the precedent slide we showed you that we were long some of those names that were pure beneficial, whether payment processing companies, Ocado, which is home delivery food, the leader in Europe, not only delivering the food, but also manufacturing the software, and the CFC, which are distribution centers. So yeah, thanks for this transition. So this slide is just showing you what happened to what we called, what I will say, technology / quality growth versus low momentum and heavy industries and cyclicals. So you see on this chart on the left, we could have gone back further out or back, but it is showing you what happened in May. Massive rebound, and that's why the Nasdaq is up 13%. So some of the leaders that we touch base on: Cellnex, Ocado, Edenred, Adevinta, SAP. Those are names that we are still owning on the long side, but we are mindful of the fact that some of those names have reached quite heavy and high multiple. So we went out of some, which I mentioned before, and we kept this list is names that we are still involved, and we believe that they are still at an interesting valuation. It's important to mention that a lot of the press, a lot of people are saying 99 and 2000, and the valuation of the Nasdaq is insane. The reality is that if you take the FANG, for instance, in the US, the valuation are not completely at all for those types of names the same as what they were in 2000. I mean, they are on 20 times EBIT, for instance, for someone like Microsoft, but they account for 25% of the S&P, but they account as well for 25% of the earnings of the S&P and 80% of the earnings in the in this specific year. So the point is, it's not all about tech is too expensive, let's sell everything. It's all about balance. You know, some of the tech is interesting. Something like SAP is not is not training on 20 times sales, but is training on 18 times EBIT. So it's a decent multiple versus its growth, even when you compare that to names that look optically super cheap in the cyclical space, in autos or in other heavy industries, because the growth is negative 40 or 50% for those ones versus an SAP growing mid-single digit on the top line and having a very high level of recurring and maintenance business. So it's all about balancing things. The second part of this slide is showing that because of these macro indicators that have rebounded massively, because of all this liquidity, because of the European fund of 750 billion that is basically going to play out and be distributed loans and grants up to 2021, we obviously need to have some of the cyclicals, but we tend to choose the ones that we believe are, again, have an equation of growth versus valuation, which is attractive. Those are names that we think are interesting, like Volvo, for instance. They have two businesses and they are at trough earnings, trough multiple, and we see some signs of improvement on the truck side, especially in the US. So obviously, those are names that we are very interested to own. So it's all about getting very, very balanced. Do you want to move to the next slide, maybe?
Yeah, let's move to the recovery fund.
Yeah, so I mean, I think this is pretty self-explanatory, but for us, it's, you know, we look at where the numbers are being spent. Recovery and resilience is extremely dominant, but clearly there's a bit more directional spending this time around, and we need to make sure that, you know, we get some of the beneficiaries of those into the portfolio in the right places. You're generally going to be longs. So energy efficiency is kind of a big green theme going on here. We've been pretty early into, I think, green winners. We're quite strong on ESG anyway. So it's these kind of themes are pretty encouraging for us. I think, I mean, they're probably the right things to be doing as well. If Europe can lead the green revolution, that's probably a good way of maintaining European economies' kind of positioning. If the US is going to be so dominant in tech, if Europe can do green stuff, that's probably not a bad place to be. And we're going to keep investing. I think we've already found a few names as well, if you want to keep moving on. Yeah. So
so maybe just a comment on that. Yes.
Yeah, these are like examples of names that we have that we like from a bottom-up perspective, irrespective of the 750 billion getting spent, and part of that being what we call the Green Deal. Some of those names are like Kingspan, is the world leader in insulation, especially in Europe. They sell a lot in Europe with more than 50% of European exposure, so they will be exposed to the Green Deal. We think that these types of names are Solaria, for instance, which is a small mid-cap in Spain and is about to triple in the next 5 years. They already have the authorization to triple the size of their solar panels and capacity. So obviously their earnings should basically triple in the next few years. And it's all about the authorization and how much euro per megawatt you basically get valued at, how much you pay for that kind of again, it's all about growth. If you triple your earnings and you discount in 3 years time your earnings, then your P looks much more attractive. So those are examples of names that we basically like. Bear in mind that this 750 billion is going to account for roughly 5% of the Eurozone GDP, so it's not a small number. And also bear in mind that it will be spent via loans and grants, specifically on economies which have been hit the most, which unfortunately are the ones which very high already at the country level, very high balance sheet and very high net debt to debt to GDP, like Spain and Italy. So we keep that in mind, and we know that you know, a name like Solaria, for instance, in a place where the sun is basically shining every day, you know that their load factor is going to be high. So another name that I could have put into this a bucket that we've been very early on, as Paul said, which is completely ESG play, is Vestas, which is an oligopoly, 2 players. Vestas, I mean, it's not 2 players, but in Europe, there's 2 players that you can really invest in, which basically makes the turbines. And this is a stock that we've been in, that has been in the fund since the beginning. We still have it. We think that the services business, because you sell the OE, you sell the turbines, the gears to make the entire facility and the wind farm, but you have a massive recurring and maintenance business attached to it, where the margins are 3 times higher. And that the more you basically grow, the more your fleet grows, the more you make money with aftermarket and services. So we attached a lot of importance as well to those kind of stories. When you can do a sum of the part basis, you know that the orders is going to grow because there's just a massive amount of wind demand, especially offshore. And you know as well that then you do your sum of the part and you make the math and you say, you know, how much you pay for the services business, which in 2 or 3 years time is going to be, you know, X% bigger. And that's the way we basically pick stocks, which are from a bottom-up perspective interesting. And when there's a macro overlay, we're happy about it. But we don't do it the other way. We don't just do macro and then bottom up. We just do bottom up, and then, you know, we know that there's a theme behind it that can help us. Yeah, I think that's pretty much it for this slide.
Yeah. Yeah, so just to fund, maybe say close on the positioning of the fund. Yeah, exactly. Just to stress on the fact that apart from having you, of course, building up the portfolio from the bottom up, you are also taking a lot of care with respect to overall volatility of the portfolio and to the risk management side, where we also use an external company called Landitech. So there are always stress tests done on a daily basis to, I mean, verify how the fund can react in some extreme event. And here, and yeah, Jamie, maybe just a comment on the today positioning also with respect to the factor risks, where we touch quite a lot today. So in the meanwhile, Paul, just a question on the UK situation. So what do you think about the market, and what do you think about the politics side? And so on Brexit, of course, which is not an ended chapter yet.
No, by no means. Yeah, so I think it's, you know, it's a little bit 2019 again in the UK. We've got a market that's recovered off the COVID lows, but not really recovered since. UK market's basically flatlined since the end of April, particularly in the mid and the small end. But most of the market's not really gone. It's not had a sort of second leg of recovery, and you know, the UK is very underloved, very underowned by global investors. And it's a bit of an orphan market again at the moment, which just means there's lots of opportunities. We know that the UK has a very broad universe, a lot of high quality businesses. And it's interesting how much money, you know, we've made both long and short in the UK. So it's a great place to operate as a market. But in terms of prospects right now, people are clearly quite concerned about how Brexit's going to pan out. And I think we will do a Brexit deal with the European Union. You know, I think that we're in a similar place we were last year, where, you know, last August people were very worried about socialist government in the UK. They were very worried about Brexit deal. So, you know, we've actually got a government which is quite right thinking and pro business, but behaving in quite a socialist way during COVID. But let's just say we can move on from that from a markets perspective. And I think we will. I think we'll see a more typical pro business government come back to the fore in Q4. And in terms of Brexit, it feels to me like it's just too big a risk now for both sides not to do a deal. So I think we'll do a deal. I think we're in peak brinkmanship between, you know, the EU saying we don't want a deal and London saying, you know, we can wait and stuff. But we had that last year and we got a deal in September. So I think we will get a deal. I think it'll be a sensible trade deal. It's given COVID, I think if anything, that's made it more likely we'll come to the table. But these things are incredibly boring, frankly, the way the negotiations go. So you have to kind of sit on the sidelines a bit and trust common sense to win out in the end. Like, I don't think anything's changed in terms of the UK's perception of Brexit and whether we want to leave the UK, leave the European Union or not. I think that just remains pretty much the same. I think it's been a difficult time for a lot of UK economic participants, because clearly COVID was pretty tough in the UK, although it now looks like maybe some of the figures were overstated and stuff. So I think what's been interesting is the unlocking. People are getting back into economic activity pretty steadily. I mean, I don't think this is, I don't think people are moving too quickly in the UK. So you probably can wait for the summer, but it feels to me like it could be a good market in the UK in Q4 as people start to look forward a bit more. You've got a pretty deeply undervalued market, a lot of opportunities, quite a broad sector exposure.
Yeah, one of the questions from the audience is how much you have into the UK market now.
All right. Yeah, I can take this question. So on the UK, we are very balanced. So we've got, as of yesterday, we were like 20%.
I'm not sure if you hear the question. So the question is how much is allocated to UK at the moment?
I can't hear. The line is very bad. What did you say? How much?
How much is allocated to the UK?
All right. So yeah, the exposure of the country is 20% of our short book and roughly 20% of the long book. So we are, to start with, we are very neutral.
No, I was just repeating the question. Probably the line is.
That's fine. I think we've answered it. 20% long, 20% short.
Yeah. I can't hear.
Yeah. Another question from the audience is what do you think could be the most relevant risk of the strategy as you can?
Well, the most relevant risk.
Yeah, the biggest risks. Yeah, I mean, I think we've got our usual. You've got your kind of usual market risk that we make a series of stock picks. That can be
Paul,
pretty
can you hear me?
Yeah, I can hear you now. Yeah.
Go ahead.
So the biggest risks, yeah, is the question. So with a portfolio like this, the biggest risks are always going to be your stock picking, because we're quite balanced. I think our portfolio risk to a change in market conditions, which saw the market fall a lot or rise a lot, isn't as big a concern as actually getting the stock picking wrong. So it's about a focus on maintaining, good stock picking and recycling the stocks. So yeah, if you think about what you get worried about, it's waking up in the morning and a big profits warning in one of your longs or a bid for one of your shorts. And in a portfolio like this, it is the stocks which are your biggest risk. I don't worry too much about what's going to happen in the wider market, particularly this year, because you've kind of seen most of it already.
Yeah, I agree with Paul, and I will add one point. We are, as you can see on our top longs and top shorts is the same. We are very diversified. We are not concentrated. So when you get something wrong, you have a profit warning on a long, or you have a big squeeze on the shorts. The shorts are usually smaller than the longs in terms of size. So you can see that Nestle was, Nestle, Rio, Arkema, Celnex, Vonovia, those are big positions, but they're never, that big. So even if you get a profit warning on a company, some of those high quality stocks that we own and we know them well, we invest in stocks that we know, that I understand. I mean, I've been looking at one name today. Teleperformance is a stock that I've been following for like 10 to 15 years. So I know the stock really well. This is one of our big positions. For this stock to go down 10, 15, 20%, it's not going to happen very easily to start with. And if it's a 2% position and it goes down 10%, you've got a 20 bips impact. So it's all about the book needs to be in stocks that we really like, but we can get sometimes stocks wrong, obviously. And on the short side, I would say the biggest risk, I think, on the single names is diluted by the fact that we are quite diversified. But I would say that the biggest risk is probably more on the short side, despite the fact that the size are smaller. Why? Because the short book is difficult in an environment of quantitative easing. The market goes up straight line. You have companies reporting very bad numbers, and on bad numbers, sometimes the stocks goes up, and you don't really know why. But there's always flow coming in, and people believe that it's the trough of the earnings. So the short squeeze are hard to manage, which is why we take care of having some sectors on one side. So we have some sectors to basically hedge some of our longs, because we believe that some longs will do better than the sector. And on the short side, we tend to be quite small in size, and we tend to recycle the short ideas. And I think the short side is probably a bit more complicated to manage because it requires a lot of attention, despite the fact that the size of the position are sometimes small. Why? Because you need to recycle them. Because when things go down, it's sometimes very violent, and then you have a bounce back. So, but as Paul said, from a market perspective, I think we're, as you can see, cyclical defensive 0 impact, value 0.02, quality 0.05. We're pretty neutral on all this stuff, but the intensity required to recycle the book on the short side is probably what I would call the most complicated part and risky part, in my opinion.
Okay.
Yeah, so we don't have other question at the moment. So I think we said a lot of things, and we pretty much covered the outlook. Of course, if there will be further questions, just let us know. By this time, thank you, Paul, and thank you, Fred. And of course, we must say have good holidays to all our investors and counterparties.
Thank you very much. Thank you for your
Thank
time, everyone. And thank you, Laura, for arranging the call. As Laura says, if you've got any questions, just come through to us. I'm sure we'll be able to answer them for you. Have a good summer.
Thank you.
Have
Goodbye.
Bye-bye. Thank you.
Bye-bye.